US stock market indices are within a hair's breadth of peak values set May 2015. Earlier in the year, stocks suffered significant setbacks, roiled by concerns over global growth. The result may turn out to be that the correction has washed out risk-averse traders, leaving investors feeling a stronger conviction over stocks as an asset class. So what clues are technical analysts looking to for confirmation that markets might burst through to the upside? Well, there are three commonly watched indicators that may be worth checking in on. For the S&P 500, the relative strength index is at a low enough reading not to concern traders, and at just above 60 remains well below the 70 boundary associated with overbought conditions. Markets often do a lot of hard work even when they reach overbought conditions. Second, stochastic indicators are already high, yet remain supportive of the current rally. Despite being at a high level, stochastics have a habit of frustrating investors by giving the impression of a tired market, only for the move to continue. Finally, the MACD, or Moving Average Convergence Divergence Indicator, recently moved into positive territory and appears supportive to the trend, even as price action tracks all-time market highs. Markets are rising around the world, and this is reinforcing to those with conviction. Here's a look at the breakout for iShares MSCI Philippines ETF, which, like the iShares MSCI Thailand ETF, surged through resistance and have already created 12 and 10-month highs respectively. Returning conviction in stock markets can also be seen in other places closer to home. First, in crude oil futures markets, price action is challenging the $50 per barrel marker as traders chew through resistance. 4 months ago, the market was void of buyers at below $30 a barrel, while today, sellers in the high 40s are drying up. The rising price of oil is good for confidence in the health of the global economy and supports better prospects for the beaten-up energy patch. Second, stock market volatility is low despite the prospect of the Fed raising interest rates and even the threat of a British exit from the EU later in June. And while a relatively low reading for volatility could be taken as a sign of complacency, it is also possible that volatility buyers are able to get all the protection they need at current prices. And for investors worried about tighter monetary conditions brought about by the Fed, well, Janet Yellen used her latest opportunity to remind investors that the jury will have to decide each time the FOMC meets. But whatever the outcome, the cost of borrowing is likely only to increase at a snail's pace. In the meantime, investors may have a hard time sitting on their hands and would rather know just how thin the air is on the other side of record highs. That's it for now. For more market color from our contributors, visit ibkr.com/ti.